If credit cards were at an all-time high and people started dipping into their home equity, what would that signal about what's going on inside the economy? I'm going to talk about all of that today. It's getting real serious right now, and I will show you the data that you need in order to confirm what you probably already know. We can see weakness going left, right, and center, and I think it's important that we check into it, that we keep up with it so that we know the truth, we can make better decisions. I'm going to show you some things that generally are not available to most people because they don't know where to look. But I'll give you those details. We're going to talk about the money mirror method. That's how to look at your investments in a whole different way. Let's begin right here. First thing, US homeowners are tapping a $9 trillion in real estate wealth. Higher mortgage rates have made cash out refinancing less attractive and pushed more people to take out home equity lines of credit. And there's a lot of equity. Let's be honest about that. But I think it's important to look at what they are doing and why they are doing so. The whole name of the game as interest rates were near rock bottom was this whole BRRRR method. And that was you buy it up, you can, fix it up, and then you can refinance that property, take the cash out because you knew that interest rates were going to remain low for a long period of time, but now interest rates are going higher. The whole plan is thrown off. You can't do that at a higher interest, so you're not going to make your money. People were making, make a few $100 here on this deal, and make a few $100 on that deal per month, and it would be a-okay. Not the case anymore. Now you're going to negative cash flow. So what people are starting to do is they're skipping on that. Investors aren't doing the fix and flips as they were before. And instead what's happening is people are, as individuals, maybe it's an investor, they're pulling money out of their existing home property and they're using that to fund their so-called investments. Is that not a potential danger? Is that not a risk, knowing where interest rates are and where they might be for several months to come? That's what I'm talking about right here. It's extreme, in my opinion, to see this happening in a time of such uncertainty. It doesn't mean that the economy has to crash tomorrow. All it means is that if interest rates remain high, that's not a good sign because we can see the writing on the wall. Credit card usage at all-time highs, student loans. We've got this whole buy now, pay later craziness that's taken off. I've seen things as small as a sandwich being available with buy now, pay later. And I'm shocked to see it all. Every single detail is adding up to show us that overall the economy is looking weak. We've got some people making money, but guess what? When they make that money, they take it and they spend it. That means if they start to get a good job, they get a raise, they buy the Lamborghini, they buy the better house, they keep moving up and up and up to keep up with the Kardashians. And that is a very dangerous system that they found themselves going into, but that's the way it works. Everybody's on Instagram, everybody's scrolling through, they've got nice this, they've got nice that, most of it's fake. But then they think, I need that too. And if not, I'm going to be depressed. So this is the world we live in today. And we could see that this is generating these massive booms and busts. And we are going through one right now. It's a cycle. What about this? Economists are cutting back on their recession expectations. Forecasters still expect GDP to eventually contract, but later and by less than previously. Well, we don't know, of course, but I can tell you something about these economists. They're always wrong. So we should never take what they have to say. Instead, we follow the money, follow liquidity. And so right now at this time, using the money mirror method, I've been looking at it very closely and assessing it at a very, let's call it micro scale. And what I have found is that liquidity is being drained out of the system. One part where liquidity is still being pushed in at a high level is the Federal Reserve basically, trying to absorb the problems that the banks have. And they're using their new facilities that they've set up. Banks are taking from that, and that is adding to the liquidity that is currently being drained out by their quantitative tightening policy. I know it's a lot of different terms and words and everything. Stick with me. I'm just explaining this. It's real simple. Okay, when we look at it, when we break free of all the jargon and all this, I'm telling you, it's not as complicated as they make it seem. And that's why I hope that you'll stick with me here because I'm going to show you some really interesting stuff. I want to show you this. How about this data? Millions of households are now priced out of home ownership, grappling with housing cost burdens or lacking shelter altogether, including a disproportionate share of people of color, increasing the need for policies to address the national housing shortage shortfall and the root of the affordability crisis. And what I think is happening is that they want to build more affordable housing in most cities because of one issue or another. They say this is the reason, that's the reason, but never did they ever address the fact that, well, what happens when you keep interest rates at 0% for like a whole decade, print a whole bunch of money, trillions of dollars, give billions to this company, billions to that company? Like, didn't Kanye West get billions or multiple millions of dollars at his company from the PPP loans, millions to this other rich guy, millions to that other rich guy? Oh, and by the way, the loans were forgiven. I mean, that's the world we live in. It is your tax dollars going to fund these companies, but they sold it to people as we have to help these companies. We're helping you too. Here's $1,400. But they don't realize that, oh, maybe I'm only getting the crumbs when the richest of the rich are going to get all the big stuff. Isn't that the reality of the circumstances? What if I was able to show you more of this? Would you be interested? Right? Let's go. Let me show you. Here we have it. Wave of rental resets to further deplete affordable housing. Expiring government protections means landlords could charge market rates. So the rates have been actually lower in many cases what they would normally be at because of the moratoriums that were in place. Remember all the restrictions that were put in place through 2020? As that expires, then these landlords could basically say, all right, I'm going to increase the rates. And that would be crazy in a sense for a lot of people because there's no way they can afford it. They can't. Cities across the U.S. face similar struggles, and we're talking here the pattern of slower rates of multifamily housing development in smaller jurisdictions is hardly unique in the Bay Area. They looked at it nationwide, found neighborhoods in small jurisdictions gained fewer multifamily units, and they just go on to talk about the whole circumstance there. But multifamily, although maybe, hey, some areas they love single family homes, other areas, they don't want to see multifamily homes, okay? They just don't want to see that because they want the area to look the way it is and they want it to be like slow and calm. And when you start to add, huge towers, that disrupts the flow, causes too much traffic. You can run into a lot of problems. But let's face it, you're moving millions of people in. You have so much immigration coming in. You want an economy to continue to grow. You want houses to be built. Well, you have a conundrum here. You have this to be dealt with, and a lot of places are going to see multifamily dwellings, or you're going to have multiple families in one household being the norm. Let's talk about something else. Looking at some stats, I'm going to show you the manufacturing PMIs. Anything under 50 is a contraction, and that's where we are at right now. Same with this. This is showing us the global U.S. services business activity index going down again. Well, it's hard to tell at this point because it has dipped down. Maybe another month or two, we can see the definite trend, but that is weak at this time. It's not in the contraction, but it looks like it's going to be heading in that territory. And at the same time, I just want to show you that a basic essential for a lot of people is natural gas. And the price, while it isn't at the record highs that we've seen in 2022, at this point, it's still higher than where it was in those previous years, 2020 and the previous 2 years. So I'm just trying to show you that things are expensive. People are struggling, and whether it's rent, whether it's your resources, food prices, everything is too high. And of course, they're dipping into their home equity. Of course, they're going to pull some of that out. Some are doing it just to live. Others are doing it at a level in which, they're trying to speculate. And that's dangerous. That is very dangerous. Hopefully, it's not too much. We only know at the end of the day. But that's something important. And these are economic indicators that I think people should be aware of so that they can make better decisions. That's what it's all about. This is talking about strikes. Labor is becoming an issue all over the place. I'll just mention a couple. U.S. strike could be the costliest in UPS strike could be the costliest in US in a century. We've saw this before. Some of these are resolved. I just want to show you how many different companies and areas are affected by it. Londoners to face a week of chaos during fresh tube strikes. Union and employers reach a tentative 4-year deal to end the BC port strikes. It's Canada, it's UK, it's everywhere. Air traffic control strike means for Europe travel. I mean, it's all over. We are seeing people upset for one reason or another. Maybe the conditions aren't right. Maybe the pay isn't good. What's going on? Let me break it down real quick. They printed a whole bunch of money. They reduced interest rates for a long period of time. That creates a disparity. That creates an unusual circumstance. And what do we got to do about that? Well, I think it's pretty clear. We have to be prepared about this. Start to take action on it, though. You don't just want to sit idly by and say, okay, when everything crashes, then I'm going to take all this cash that I have on the sidelines and then put it somewhere. Some of that should be deployed right now. You've got to put your money, some of it, in a place that is mitigating the effects of inflation. And also, you don't want that regret that I waited so long and I didn't go ahead. Look, if you don't have that money for a piece of real estate, for instance, sometimes it's better to grab a group of people, 3, 4, 5, 10 people, go in, buy that property. I know it's shared ownership, but yeah, it's also shared responsibilities. So between you people, you can all get together and do that. And maybe at the end of the day, 10 years from now, you can buy all their positions out if you wanted to, or you can sell your position. Who knows? The point is, don't wait for the perfect moment. You're never going to find it. So always act when you can. Anything that is a real asset, has real value, and you got to do your due diligence, but you want to invest in the right things, and it's what is tangible. That's what's going to be able to mitigate the effects of the inflation. We know that inflation's here. We could see that. We can look at that. And even if we do get deflation, the central banks are aiming for inflation. We know that 100%. There is no question about this. They have made it very clear that they will meet any bit of deflation with serious pedal to the metal inflation. So what's happening right now with the money mirror method? A quick update, and that helps us to understand what's going on, okay? So we have number one, quantitative easing. That has gone away. We have quantitative tightening. They're reducing their balance sheet by selling off treasuries, and they are selling off mortgage-backed securities. That's one aspect. At the same time, you have overnight reverse repos. So reverse repos, just a quick summary, is like the more of it that there are, the more liquidity there is in the system. That's been going down. Still high, but that has been going down. The trend has been very clear. Another one, the Treasury General Account. That's like the checking account of the Treasury. That has been starting to fill up. So the more depleted it is, that means like the more they're spending. That's stimulus. But now it's starting to fill up. Less money is being spent through there. And so another method of stimulus being depleted. And then, we look at the policies that have been put in, the new facility that was put in by the Federal Reserve to help the struggling banks. That has been increasing, at least compared to where it was when it all began. It's been something that is at or near record high by the time you watch this. So there has been stimulus from that side, but stimulus has been taken away from other sides. Overall, though, it is actually being drained. It is a net negative, and that means for you that it's creating a disparity in between where the stock market currently is and where it should be. So something's got to give. Either you're going to start printing a lot more money, or that the stock market has to stay where it is in order to get basically caught up, or it could decline from here. My indicators show that there's been a lot of investment coming in, and perhaps a little bit of weakness is overdue, but that's the way it goes. It's all going within the Bollinger Bands, and if you look at Bollinger Bands, you can see that for yourself. I don't want to get too detailed on that, but let me know. I'm going to be bringing on all kinds of programs, all types of things, so that you can just know exactly what to look for. I've got all the knowledge right here. It's so hard to do so in just a video because I'm using the news, I'm using all these things, but I'm going to be building out programs. One of the places where you can get a lot of free information is my Discord. I'm going to continue to mention it. It's right here. If you want to check it out, I reply to people every single day in there. And I'm going to be doing the giveaways for the mentorship group through Discord. The only way you're going to be able to get a free session in the mentorship is through Discord. So check it out. It's free, obviously. Check it out, description below. You just got to click that link. That's the invite. I'll see you there. Take care.